Welcome, everyone, and thank you for joining. Joe Philistin is the Financial Wellness Program Director at the University of Pittsburgh. Prior to that, Joel worked as the financial coach at the Houston Community College and financial literacy educator at the College of the Mainland. Joel learned the importance of managing money during his college years and while working in the banking industry. His goal is to help students and his community avoid the financial mistakes he made and help students gain financial success. Joel completed his bachelor's degree in business administration at Montclair State University and a master's of public administration degree at Keene University, both in New Jersey. As an FYI, you cannot unmute, but you are more than welcome to drop questions in the chat throughout the presentation. We will present those questions to Mr. Philistin during the question and answer portion of this event. Thank you so much.
All right. So, all right, good afternoon, everybody. It's good to be back with my HCC Eagles, getting the chance to discuss credit with you and some aspects of how student loans impact your credit in the long term. This was always a favorite of mine when I was at HCC to discuss credit because I always found out students had questions on it. And here at my current institution at the University of Pittsburgh, my students have questions on it. So I'm going to give you some of the, basic information that you need to know. And then I'm going to go ahead and just encourage you to follow up with your HCC financial coaches for additional information. Always remember, I started off as an HCC financial coach myself and had the opportunity to move into this director role where I'm at in the University of Pittsburgh now. So without further ado, I'm just going to go ahead and get started for the sake of time. And there we go. So, all right, here's what we're going to be discussing today. We're going to discuss what is credit, how can it be used, all that good stuff, different types of credit. And then after that, we're going to just take the time to break down how is the credit system used or how a credit decision is made. The last thing that I just want to finish off with is just letting you know how credit and student loans work together. So without further ado, let's go to our first slide. So, I want to use the chat on this one. Anybody, I do have a definition up here for you, but what would you say is credit? Give me your perception. What is credit? Using the chat, give me some of your perceptions of what is credit really quickly. I'm monitoring I'm looking at the chat right now. I want to see some answers, or, you can make it as simple as something simple. Maybe you think that credit is a car loan, but go ahead and just give me a few quick examples of what do you think is credit using the chat. Okay, borrowing money with the intent to pay it back, an alternative to money. So, okay, good. Anything else? All right, so these two responses right here are pretty much some good definitions of it. On the screen, we got a quick little example just saying that credit is your ability to borrow money or goods from a financial institution, entity, based on the trust that you'll pay that money back. Now, when it comes down to it, it's essentially like a financial tool. So let's say that you don't have the ability to pay for a $40,000 car right out of your own bank account. One of the things that you could do is, I'm going to use this word called leverage. You could leverage some of the money that you already have. Let's say you take a down payment, maybe you have $5,000 saved. You leverage that money, you say, here's $5,000. I would like to borrow $35,000 to purchase this vehicle. Now, because you have good credit, or what we call, standard credit, that means that the financial institution or whoever you're asking for the money, for the funds, for the particular good, basically, they trust that you will repay them. So therefore, they're going to give you this money and they're going to lend it to you. So when you think about credit, it's really an extension, or it's a financial tool that allows you to make certain purchases, that allows you to receive a certain asset without having to have the full sum of the money up front. Um, Basically, all of that is based on trust. So when you think about credit, think of it as this: they're crediting you. They're crediting you, saying, you know what, we trust you that you'll pay this back. If you are someone who's not trustworthy, then they most likely won't give you that credit at that point. So, kind of like this little slide that we have here, that kind of breaks it down, right? This slide breaks it down really perfectly, where we got this cartoon of a bank and it says, you once borrowed a quarter from me in grade school and you never paid it back. So if you're someone who doesn't pay your obligations back, then guess what? Financial institutions or other entities, they won't trust you, therefore they won't give you that credit. So when they don't give you the credit, of course, you're not getting the funds so that you can be able to use that financial tool to like get some of those assets that you are looking to receive. Now, just for a quick example, what's some examples where you would use credit? Let's use the chat one more time. Give me a few examples where you would use credit. And I gave you one, but give me some more. Give me some different types of credit or some different examples using the chat. Starting a business, perfect. Any other ones? Starting a business, mortgage, there we go. Anything else? Anything else? Think of any school, perfect, perfect. Other ones, credit cards for personal purchases, perfect, perfect. Any other ones? You could throw it out there. If you have vacation, yeah, you can use credit for a vacation. We saw business, we saw mortgage. So we're seeing some great examples. So holiday funds, yeah, you can go ahead. Like if you're using holiday funds, you can do like an all-purpose loan, or maybe if you're using a credit card, for example. So loving some of these answers, and I'm going to go ahead and follow up. Everything that I had on here, y'all basically nailed it down to a T. When you are using credit, it basically give you a chance to purchase that home, purchase a vehicle, educational expenses, for example, starting a business. Sometimes it could be something as simple as going to a supplier. Like when we're talking about a business, sometimes you will go directly to a supplier and say, hey, I need to borrow X amount so that I could purchase this equipment to start my business. And then if you're paying them off in pieces, then that supplier trusts you to like continue doing business with them. So credit is very important when you think about it, both personally and as you think about business. Now, basically in the process, when you go ahead and you pursue credit, most of the time you will have to apply for, you will have to complete a credit application. And with that credit application, you're going to get a credit agreement. Now, the credit agreement basically breaks down like what are the obligations in this like contract. So remember how I was telling you that it's all about trust. So when I give you my funds, most likely I'm going to tell you sign this dotted line of like, here's what you have to do in order for you to maintain your credit or maintain these type of funds that I've given you, and here's what I'm going to do in the process. So some of the things that you will hear most of the time when you're thinking about credit, you're going to think about lenders, and then you're going to think about borrowers. Of course, the borrower is the person who is receiving the funds, right? The lender is the one who's giving the funds. Now, some of the things that the lenders are going to put in the credit agreement is, number one, are they charging you an interest rate? Most of the time, when you borrow funds, there will be interest rates involved, because that's how the financial institutions or the banks, that's how they make their money. So when it comes down to it, if I'm giving you a loan, I'm not doing it just because I want to be a nice guy. I get to make a profit off of it. So if you're being charged $10,000 within an annual interest rate, and I'm charging you, let's say, 20%, right? That means I'm going to make $2,000 in interest off that loan per year up until you pay it back. So that gives me the chance to like make some profits off of me lending you money. And that's how financial institutions work, or banks. Banks basically lend money for an interest rate so that they can make a profit. Now, in That credit agreement is also going to tell you how is the interest rate calculated, whether it's like calculated daily, monthly, yearly. Most of the time, just breaking down some of those details for you so that you know how does that happen. Now, another one that you will see out there is the repayment schedule. Like, what's the date of my repayment? What's minimum payments that you have to pay? Now, that means a lot because with different types of funds or different types of credit accounts that you will receive, there's going to be some of those different payment options. Some of them will give you a chance to pay the minimum payment. Some of them will ask you for the same fixed payment every month. So you do want to be mindful of that as you sign your credit agreement. Other things you're going to see is the fees, of course, telling you like what fees are involved, whether there's annual fees, late fees, basically if there's a transfer fee. So basically it's also going to give you like consequences of non-payment too, just in case you aren't necessarily making your payments on time. So I do want you to be aware of this, that there is that credit agreement. Once you sign that dotted line, basically you and the lender are in this agreement together, and now you're building trust by making sure that you're paying them back on time. Now, really quickly, I just want to give you like a breakdown of like credit versus debt. Credit isn't exactly like debt, for example. So let's say I go to a car dealer and I apply for a car loan, right? When I apply for that car loan, the financial institution approves me for the loan. Now, basically, they give me either a check or they tell me what I have to do, or they tell me how can I access the funds, right? Essentially, they've given me the check, they've given me the funds. It doesn't actually become debt until I go to a car dealer, purchase a vehicle, and then from there I have debt. Prior to that, credit is basically them approving you for the funds. So a credit card works the same way, right? You receive a credit card. That credit card just stays there with the funds loaded on the card up until you go ahead and swipe the card. That's when you start to create debt. So basically, credit turns into debt, but they're not necessarily the same thing. The reason why that's important is because I really want you to understand that you should limit how much debt you have. So if you have a credit card, for example, you don't want to overuse it. It's a great thing that you have been extended credit. But if you overborrow or if you overuse it, then you're going to end up owing more money. You're going to end up having to pay more interest. Let's say you get approved for a car loan worth $60,000. Your bank sends you a nice little promotion telling you, hey, you got $60,000 in a credit that you could use towards a car loan. And your first reaction is, well, I'm about to go ahead and buy that tricked out F-150. You know, it's it is going to cost a lot for me to pay every month, but essentially I can afford it because they've given me this nice size car loan. Now, one of the reasons why that's so important is if your budget cannot afford that vehicle, there are some consequences to that. Anybody want to type in the chat? What would be the consequences in case you cannot pay your car payment or your car note? What's the consequence? Somebody throw it in the chat for me really quickly. Let me get someone to throw it in the chat. Repossession. Thank you. Thank you so much for putting that in there. Just in case you don't know what repossession is, that's where the financial institution says you can't pay your debt, so therefore I'm going to repossess this vehicle. I'm going to take this vehicle, and I'm still going to sue you to pursue whatever you have not paid yet. Now, one of the reasons why that's so important is because that all starts off with you taking out too much debt. It's great that you can receive credit, but if you are taking out too much debt, it's going to impact your ability to be able to receive assets without paying for it, right? So like credit gives you that opportunity to receive that asset, and then you pay it over time and you keep that trust going. But once you have damaged your credit, now you're in a position where you cannot access funds in the future for other assets that you would like to acquire. So I want you to be very clear on that, making sure that as you pursue credit, as you build credit, that you do not overborrow, that you stay within certain limits. And we'll touch some of that. All right. So, as we're talking about credit, I want to tell you about some different types of credit. Number one, we have installment credit, and then we have like revolving credit. These are your main credit categories. Now, installment credit is any type of loan or um, extension of credit from a financial institution where you receive one lump sum or one amount for a specific purpose, and then you're going to pay it off over time in equal payments. So if you received a car loan, for example, you're receiving $20,000. After you've received that $20,000, you can't necessarily go back into that account and take out more money. Once you have received that one lump sum of $20,000, what the bank calls it is you pay it off in installments for the rest of the life of that loan. You can go ahead and like go to another financial institution and take another loan to pay off that loan, but you still will be paying what we call installments, which are equal pieces of like monthly payments. So if it's $200, $300 a month, basically you're paying it off in those pieces. Now, the other type of credit that you have is something called revolving credit. And the reason why they call it revolving credit is similar to like if we go through a revolving door, which goes around and round, you go in and out, in and out. With revolving credit, what happens is you do receive, let's say, $10,000, right? You receive that lump sum in that credit card. The difference is you can use the credit card as long as you use the credit card and you pay it off. You can continue to use that sum of funding that was given to you. So with revolving credit, it's just like a revolving door. You could go in and out as much as long as you continue to repay it. So you can use the card as much as you want as long as you continue to repay it. Same process of like a revolving door. In and out, same thing. In and out. Pay it, you use it, you pay it. You use it, you pay it. So it's that same process of it's revolving, it's available to you. All right. So that's the difference between what we call installment credit and revolving credit. So I have a quick question for you. What is one type of installment credit that many students, college students have? What is one type of installment credit that many college students have? Let's use the chat for that. And you could take a guess. I won't judge you. Okay, perfect. Perfect. You hit it right on the nail, Helena. Student loans. And just in case I said that right, please, I apologize. Said that wrong, please, I apologize for messing up your name. But you hit it right on the nail. Student loans are a type of installment credit because you receive one lump sum, and then when the time comes, you have to repay it in equal installments. Whereas revolving credit, as long as you pay it, you could continue to use it. Now, installment credit is interesting also because installment credit has a very distinct way that it works, and it gives you the possibility of avoiding interest rates. Most of the time when you're looking at installment credit, you're going to be charged some type of like interest rate immediately, right? Or not immediately, but most likely you're going to pay some of that interest back. With a credit card, you're not necessarily charged interest immediately. There's basically a very clear system of how credit cards work. So for a quick example, let's say we have Sherry. She has a $3,000 credit limit. She spends about $1,500 on that credit card, right? Excuse my dates. My dates are off. I meant to put October 9th there. So don't pay attention to March 9th. But essentially on March 9th or October 9th, she uses her credit card and she spends $1,500 on it. Her statement closes on October 31st, right? When her statement closes on October 31st, she owes the $1,500. Now, with that, she has an interest rate of like 20%. on her credit card. Sherry has two options. When she receives her payment on, let's say, November 14th, she could either pay the full balance off, the full $1,500. She could pay the full $1,500, or she could pay the minimum and carry a balance into December. So we'll take a look at what that looks like, right? So if she pays off the balance, basically, Sherry will pay her balance on November 25th. Basically, that will bring her owed amount down to zero, and she will not be charged interest. It's the best way to use a credit card. Essentially, it gives you the opportunity to save money because now you're not being charged interest. All you're doing is just using the credit card to go ahead and make the payment, and then you're paying off the full balance at the end of the month or on November 25th. Now, let's say she's carrying a balance instead. So let's say instead of paying the $1,500, she pays the she only pays $50 towards that $1,500 balance that she owes. Basically, her balance is going to go down to $1,450. Now, what happens is the balance that she did not pay gets carried over into December. In December, she will be charged $24.21 because the financial institution is now going to start to charge her interest. So her new balance won't be $1,450 in December. Rather, it's going to be $1,474.21 because she was charged interest. Everybody got me on that? I know I kind of went back and forth on the numbers. Let me get some like either yes or some Y's or some N's just in case you got the how does interest calculate on credit cards. If you got it, give me a Y or a yes. All right, perfect. I'm not seeing any N's or no's, so it looks like perfect. So I explained that clearly. Now here's the interesting thing. Towards the end is where I'm really like I really want to sell this point to you of like managing your credit cards responsibly so that it doesn't cost you. Of course, if she keeps only paying the minimum, remember, Sherry borrowed the $1,500. That was in October. If she decides to only pay the minimum and continue to be charged interest, it will take Sherry almost 2 years, no, actually over 3 years, to go ahead and pay this one credit card off. Now, on top of that, she would be charged $547 in interest to repay the balance. So something that cost her $1,500 now will cost her $2,047 just because she's only paying the minimum payment. So when it comes down to credit cards, you don't want to spend more than you're able to pay back. Like usually they suggest that you carry credit card balances less than 30% of your credit limit. So if we're talking about $3,000, less than 30% would have been like $900. Like she shouldn't be carrying a balance of $900 from month to month. Now she can and still maintain a good credit score, but it's going to cost her more. So I'm hoping that that made a good impression on you, just helping you understand that it's better not to carry balances on your credit cards. Now, quick little breakdown of how the whole credit system works. The credit system works like this. It starts off with you, right? Now, like we were saying before, it's you who we will call the borrower. Then we have the creditors, which we call lenders, right? Financial institutions. And if you're looking here, one of the things that you'll see connecting the borrower and the lender is account information. So you submit your application. In the process, the creditor is going to check your credit report and your credit scores. Now, the place where the lender receives that information is from the credit bureaus or credit reporting agencies. They house your credit report and your credit scores. So the whole purpose of the credit bureaus is basically to track what new loans, what credit you receive, what credit applications have you completed. Because remember that the whole system of credit is based on trust. Well, you can't just look at someone and say whether they're a dependable person that will pay you back. That's why the credit bureaus are there to provide the financial institutions with that information so that they can make the appropriate financial decisions on you and they're not taking on too much risk. And you, therefore, are sharing that information with the credit bureaus. So the credit bureaus are a part of that credit system to help maintain trust. So if you're paying your credit on time, then you get a good credit score. If you're not, you get a bad credit score. You get a standard credit score, very good credit score. But that's how they basically track it. Now, the three major credit bureaus are Experian, Equifax, and TransUnion. Those are the three major credit bureaus that are used in the US. Now, like we were saying, as we look at it, some of the questions that are answered on the credit bureaus or on a credit report is who do you owe? How much do you owe? Do you pay creditors on time? How long have you owed? How frequently are you applying for new credit? Different things that like are really important. So that's similar to this. Let's say, for example, this question, how frequently do you apply for new credit? One of the reasons why that's so important, and we call that inquiries, right? That's what we call that section. One of the reasons why that's so important is because if you're always applying for credit, essentially it looks like you don't have the funds to finance your life. It's just like a friend. If they're always asking you for money, then you're going to look at that friend and say, why are you always asking me for money? Like, do you not have your own money? Like, what's going on? Like, you're always asking me for the money. Same thing with a credit bureau. So if you're constantly applying for new credit accounts, credit cards, car loans, it ends up hurting your credit score. So few quick facts of like how the credit system works. And of course, your credit report, the credit bureau will create a credit report, and based off of your credit report, you get a credit score, which basically gives the likelihood that you will pay your credit obligations on time. So the higher your credit score, the more trustworthy you are. The lower your credit score, the less trustworthy you are. Now, why does that matter? So quick little glimpse of it. The higher your credit score, the less you pay in interest, because remember, you're more trustworthy. So if you have a great credit score, quick example that we have here for a mortgage, the people who were in a 760 to 850 range paid a lower interest rate on a $150,000 mortgage, right? Because of that, they had a lower monthly payment, and they actually paid less interest back to the financial institution because the financial institution can trust them. Now, if you are someone who is with a lower credit score, you get a higher interest rate. That higher interest rate leads to a higher monthly payment, and that monthly payment leads to you paying more in interest. So when you think about like credit, your goal is to have the best credit score possible, which means that you want to avoid over borrowing, like we said. All right. I'm going to grab this question in a few hours. I saw, how do I build my credit score? I have a minimum wage job. So I'll go ahead and touch some of that really quickly. Give me 1 sec. I'm just going to get through these 2 slides here, and I'll go ahead and touch that. So here's what you need to know about the credit score calculation. 35% of your credit score is made up of your payment history. So if you are paying your obligations every month, that's 35% of your score. So you want to make sure anything that you take out, like let's say you take out a credit card, make sure that you're paying it back every month. If you can't pay it back, then I want you to call your lender, and sometimes you can work a situation out with them where they'll take in less. But the majority of your credit score, the thing that matters most as far as like a percentage wise is your payment history. So you want to make sure that you're always making payments. Number 2 is going to come out to like what amounts do you owe? So kind of like how we talked about credit cards earlier, where we talked about having a $3,000 credit card, for example, right? If you're using $2,900 of that credit card and you're carrying a balance of like $2,800 into every month, then you are using more than 90% of that credit card, which does not look good. Because basically it's stating that like if you should like run into an emergency, how likely it is that you will be able to pay this credit card. So 30% of your credit score is going to look at whether you are borrowing within safe limits. The other three categories, length of credit history, that comes with time. So the longer you have credit, the more you're trustworthy. So when I first received like my first credit card, I was less trustworthy. Most people would say, well, you got to build your credit history. I got to really see how do you operate with credit before I can make a decision on you. Basically, now that I'm like, 20 years in, you kind of look at my credit report and you'll be like, hey, like this person has been managing credit well for a while. Like I think we can trust them with like managing credit. So that helps to boost your score. The last two categories go to be credit mix, which means you come to a point where you have different types of credit, like we were saying before, like revolving credit, installment credit. So maybe you have a car loan, maybe you have student loan, and you also have a credit card. And I can see that you can manage all three of these well. That's 10% of your credit score, being able to see whether you're able to manage a mix of credit. Now, the last thing is going to be new credit, which we kind of covered. Like if you're always applying for new credit, it hurts you. So you want to like only apply for new credit when you actually need to, not because you just feel like it per se. So just a few little tips. Now here, this was just breaking down the amounts owed section. So like we were saying before, let's say you have a $5,000 credit card, you're currently not using the balance on that. You have what we call a 0% utilization rate, which is basically the amounts owed. But of course, if you have this $10,000 credit card and you're borrowing $8,000 from it, basically you're using 80% of that credit amount that is available to you. So that's using 80% of your credit score, of your available credit, which is not a good thing. Usually, like we kind of stated earlier, you should aim to carry a balance of less than 30% on your credit cards. Now you could go beyond it. It's just as you're looking at your credit score, it may impact it somewhat, specifically that amounts owed section. So, be mindful of that as you take out credit cards and you go through your credit process. So we had touched up on some of these. Now, one of the things that I do want to tell you is like ways to maintain a good credit score. Number one, make payments on time, carry low balances, do not apply for credit excessively. And the third piece is probably one of the more important pieces. I want you to check your annual credit report every year, which is free by going through annualcreditreport.com. You want to make sure there's no inaccurate information also on your credit report because that can impact your credit score. So I really want to stress to you that you check your credit report every year so that if there's information that's not supposed to be on there, you can get that information off. But maintaining a good credit score comes down to these, like making payments on time, carrying low balances, not applying excessively, and basically building your credit history over time. Now, to stop really quickly, I'm going to answer this question. I know you said, how do I build my credit score? I have a minimum wage job. So one of the ways that you could build your credit score is, well, I'll give you two ways. Depending on if you have a family member where you can become an authorized user on their credit card, for example, that's one way that you can do it. You do have to like pay, make sure that they're paying things on time, that you're paying things on time. That way you can build your credit score that way. Now, most of the time, people can't just, jump on and be somebody's authorized user, right? So let's say you apply for what we call a secured credit card because you most likely don't have credit established yet, especially if you're a college student, maybe you're 18, 19, and you're just now starting off. So if you get a secured credit card, essentially you're going to the bank and saying, hey, I would like to get a credit card but the bank doesn't trust you yet because you have no credit history. So they're most likely going to deny you. So instead, what you do is, let's say you save up $200, $300, maybe $500, and you put it into a savings account. And what the bank is going to do is they're going to freeze that money. In exchange, what they're going to give you is a credit card at that point. They're going to say, manage this well. And if you manage this credit card well, in 1 year, we'll give you like your own credit card, right? Perfect. Or a secure loan. Thank you. So when they give you that credit card, essentially what they're going to do is they're going to watch whether you manage that credit card well. If you don't, what they then do is they take the $500 that you put into the savings account and they recoup their losses. So it's a good way for them to be protected from you not paying on that credit card, right? But on the back end, let's say you're managing it well. So now that's going to help you build credit amongst them. And then from there, at one point, they're going to give you what we call an unsecured credit card, meaning that there is no security interest or no savings account backing that. Meaning now they have built enough trust to not ask you for a security interest. Is that clear for you? And that's just one way. There's also through like a secured loan, but I'm going to put it in the chat. That way, just in case you want to look it up some more, you could go ahead and look at a secured credit card, for example. There's the secured loan option, of course. If you can get somebody to be a co-signer on a credit card with you, those are a few different ways that you could start to build credit on your own. And one of the things I also encourage you to do is check out Experian, Equifax, and TransUnion. They have plenty of education on establishing your own like credit card and everything. So I'm just gonna get through these slides really quickly and I'll answer that next question. So for the last pieces, just want to like wrap it all up. Remember that student loans are a type of credit obligation. The good thing about student loans is you don't have to apply for it, similar to like a car loan or a credit card. All you have to do essentially is enroll in school. Let's say you are a US citizen or a permanent resident. Essentially, you can receive student loans that way. Good thing about student loans is you do not have to pay it back until 6 months after you graduate or you are no longer enrolled. Now, some of the ways that student loans are similar to any other credit application, just like we talked about a credit agreement earlier, the master promissory note is going to be your credit agreement. Now, one thing about student loans is like while you're in school, you are not required to pay it back. Remember, 6 months after you graduate or you are no longer enrolled, that's when you have to begin to repay it. But I do want you to know that different types of student loans accrue interest while you're in school. So your subsidized loans do not accrue interest, but your unsubsidized loans do. So as you're thinking through that, one of the things that I can tell you is if you have an unsubsidized loan, when you graduate, it most likely is going to be higher than the amount that you borrow. So that's something for you to like consider and think about. Now, the second thing is we talked about like over borrowing. One of the things about like federal student loans is because you are not having to pay it back, it's very easy for that student loan amount to balloon on you. So you might take out $10,000 this year and you're like, oh yeah, like it helped me to pay for like, some of my expenses, but I also went ahead and used some of that money towards going to the movies, going on a vacation, doing X, Y, Z, which you can do. But 4 years from now, when you graduate and you look and you say, man, I have $40,000 in student loans and I have to pay that back. That's how some of the ways that it can impact your credit score. Because of course, like we were saying, if you're over borrowing, then you're going to end up having to pay way more money back. And especially if interest is starting to calculate on it, you then are stuck paying off the interest also. So that's what some of the places where I want you to be mindful about, like some of the loans that you're borrowing right now, do you really need it? You know, if it's certain things like paying for your classes, of course, paying for your books, perhaps it's helping you to pay for transportation, even food, because for what it is, student loans are there to help to pay for educational reasons, right? But once you get to a point that you are using some of those funds really just to, you know, enjoy life and just to create extra money for yourself, that's going to cost you one day. So I do want you to be mindful of that and how it will impact you after you graduate, because you always want to be mindful that you will have to pay those things back. All right. So borrow what you need. Don't borrow what you want, but borrow what you need instead. Now, most of us, if you're going to a 4-year, you most likely will take on student loans at your 4-year. And I do want you to know that like private loans are a little bit different, especially as you go into like your 4-year institution. So be mindful of that too. Now, consequences of non-payment on student loans. You can have a damaged credit report, which will lower your credit score, which earlier we touched on that. Like if you have a lower credit score, it's harder for you to like get assets based on trust. So I want you to be mindful of that. Now, of course, if you're not making those payments, some of the consequences are additional fees, interest being accrued, leads to high payment. So I want you to be very mindful of that. It also could impact future job opportunities. So be, clear that if you're going into a financial institution, there's insurance companies, different companies who check your credit score and check your credit report before hiring you. If you're not paying your student loans, sometimes that can impact some of your job opportunities. Now, the other thing is it can lead to like loss of tax returns, the ability for you to receive financial aid, wage garnishment, different types of impacts that it could have. So I do want you to be mindful and try your best not to overborrow, especially as you're thinking about student loans. Now, on the flip end, I do want you to know this too, that student loans, like once you go into repayment, actually can help you build a good credit history. Now, this is after you graduate more so. Always remember, on your credit report, as long as you're paying your debts, 35% of your credit score is, student loans. So it also helps if student loans are on your credit report, it can help to boost your credit score. Still want you to be mindful about how much you're borrowing. And the other things that I do want you to know is when it comes down to it, when you do go into repayment, there's plenty of repayment options. You could speak with your HCC financial coaches, but I left a little link in here just helping you understand some of the different repayment plans that are available. So I don't ever want you to feel like, I don't have any hope of paying back my student loans. You definitely want to be clear about like some of the repayment plans that's available. And if you can't pay your loans, there are also deferments, forbearances that can help in the processes. Now, the last thing that I could tell you on student loans is like paying more than the minimum payment if you can. The quicker you pay off your loans, the better it is for you. You end up saving more money in the process. So when it comes down to it, definitely want to position yourself to, save as much money as possible. So paying like more than the minimum definitely will help you. Now, just in case if you need to go ahead and contact the Department of Education to find out how can you postpone your loans, you can ask about deferments, forbearances, several different things that are available through the Department of Education when it comes down to repaying your loans. So with that, one of the things that I want to really encourage you to do is reach out to your HCC financial coaches. I started off as one, of course, and I've transitioned into my new position as of last year. But great to speak with them about financial emergencies, head out to some of their events, maybe get on one-on-one financial coaching, options to fund your education, talk about student loan debt, a few different things they could speak with on that they could cover with you That way you could get additional information. So to finish up, so what is the difference between a credit union and a bank? So a credit union is a financial institution that's a not-for-profit financial institution, meaning that their profits, they don't necessarily like build profits for the sake of the business. They build profits so that they could go ahead and offer services to their members. So they're a little bit different from a bank that operates to build profits and to go ahead and take those profits and to give it to like shareholders or to like investors in the bank. So like a Bank of America, for example, if they earn profits, most of the time they're giving that back to investors. Whereas a credit union, their whole purpose is to benefit their membership. So by way of that, they usually offer like lower interest rates or on credit cards. Sometimes they can give you a better rate on a car loan, for example, because the money that they're making it, they're reinvesting it back into the actual financial institution, which results in better like interest rates, services for their membership. The difference with a credit union is you have to be able to become a member. So sometimes you do have to be like employed at a certain organization, live in a certain area, some of those different things. Whereas a regular bank, you could easily just walk up to them and say, I want an account. Only thing is they're not investing all of their profits back into the services of their customers. They're also operating to bring, you know, to bring profits to their investors. Now, what can I do if I want to get an apartment and I'm new to this country and credit is involved? So, if you want to get an apartment and you're new to the country, credit is involved. The first thing is like, is it necessary for you to move into an apartment immediately? I'll first like take that time to ask yourself that question to really like plot out like what's best for you financially, because you can essentially like get an apartment without credit. Only thing is at that point you're kind of limiting your options, especially if you're dealing with a landlord who's not asking for credit, who isn't going to be as accountable to like some of the needs that comes with maintaining an apartment. So if you're thinking about like moving on out on your own, first and foremost, I would say slow down and think if you really need your own apartment. Number two, make sure you have a budget established, so that you could prepare to pay that monthly amount every month. Then third, if you don't have to do it immediately, perhaps take the time to go ahead and establish credit. Maybe that's through like getting um, an authorized or getting somebody to co-sign on your credit card. Sometimes you could get somebody to co-sign on an apartment with you also, but most of the time people aren't like as willing to co-sign, but it's always an option. If you don't have to like jump into it immediately, I would say, take that option of building credit. And if you say like 6 months, a year from now, I'm going to go into my own apartment, then you could do it then. But first, take that time to say, do I really need to do this? And then like make sure you're building your budget, of course, because the most important financial tool you can have is a budget. That way, you know where your money is going and you know what's possible in the future. Credit doesn't work unless you are budgeting well. Like we were saying, like if you overborrow, it can hurt you. So having a budget lets you know like what's realistically possible. Um, so recap, we really just went through like understanding credit. Number one, um, understand that credit comes down to trust first and foremost. It's all about trust. So when it comes down to trust, it's really saying, can you be trusted to borrow money from individuals? So when it comes down to like a financial institution, they're looking at a credit report to see whether you're a trustworthy individual before a lender will like give you money. Some of the ways that you could build that trust is through like, a secured credit card, for example, through credit cards, through secure loans. But before you do that, make sure that you have like a good budget in place financially. to like really begin using credit, because it's a tool if you're using it correctly. If you're not using it correctly, it could be a detriment to you. Some of the ways that credit is calculated is, number one, by looking at whether you pay people back on time. Number two, by checking whether you overborrow. And number three, by your account history. Like if you've had credit for a long time, then you're a little bit more trustworthy. Number four, by looking at like how do you manage different types of credit. And number five, by seeing if you're applying for too much credit at different times. So one of the things that I believe is that the session is recorded. So the recording will be provided for you to help you like get some of those additional points.
Thank you so much for all this wonderful information.
Thank you. And y'all have a great day. It was great to go ahead and share with y'all one more time. Go Eagles.
And congratulations on your new position.
Oh, thank you. I appreciate it, y'all.
If anyone has any additional questions, you could please post those, and we have a few more minutes.
Thank you, Ms. Alexis. And thank you, Joe. This was a great presentation, very informative, and we definitely appreciate you coming to share that information with us one more time. And for all my Eagles that are on the call, if you are attending this event for points, you can expect to see your Eagle points and the Eagle Experience profile within the next 2 days. The recording will be available for playback, and you will receive an email with the link to that. 3 of our lucky students who are on the call will receive a $25 e-gift card. It's completely random. We'll put all your names into like a spin wheel, and it will choose 3 winners randomly. So please be on the lookout within the next couple of days to your student email. If you are a winner, you will receive an email that lets you know how to redeem that e-gift card. And that's going to be it for me. So thank you all again for coming. Thank you again, Mr. Philistin. Thank you so much for moderating, Ms. Alexis. Have a great day, everyone.